Greetings, class, and welcome back. This is Finance 101. This is the video for Chapter 9. I tried recording it earlier in the week and had major problems. So I'm putting it up right now. We will talk about it some in class on Friday, but I'm going to go through this and you can watch this video and then respond to a quiz that'll be online. So anyway, right now we're going to talk about Chapter 9, which is risk management, insurance. How do we deal with, well, what is insurance actually? Which brings us to the first slide that I want to talk about here. If we were in class, I would ask you guys to discuss this. Why do you need insurance and what is it? So we have four possibilities here. A financial tool to avoid risk, a contract that pays for all of your healthcare costs, a way to transfer risk of loss to another party, or a way to financially protect your health. Well, um, there may be some element of truth in some of these answers, but clearly the right answer here is letter C. We use insurance to transfer the risk of loss to somebody else. We pay them for that risk that they take with premiums, and then they take the risk of loss. We don't have that anymore. So why do you need insurance anyway? We talk about human capital in this course, and basically that is your ability and willingness to work, learn, um, make good decisions about money, things like that. Human capital is one of your most valuable assets because without that, you're not going to make a living. You need human capital to do that. So, the greatest risk to anyone's human capital is the deterioration of health. And when we talk about that, we were talking about different factors that determine how healthy we are. And if you look at this graph, you'll see the biggest chunk here, 40%, um, is health behavior. So, depending on what kind of behavior you're engaging in, if it's risky behavior, or if it's more healthy behavior, that's going to impact your health. 30% of it is going to be genetic disposition. So, in total, 70% is made up between the genetic disposition that you have and what kind of health behavior you're engaging in. Smaller amounts relate to the social circumstances you live in, what kind of medical care is available to you, or even the environment that you're living in. So those are the other factors. I have another question here, and this is again, what do you think? A problem with living an unhealthy lifestyle is that, and we have several choices: severity of future risks, frequency of future risks increases over time, the ability to transfer risks increases over time. And last one, severity and frequency of future risks increases over time. The best answer here is letter D, because as you age, the severity and frequency of future risk increases. So there's this neat little diagram here in the PowerPoint called the risk matrix, and basically what this is it ranks the severity of the risk as low, medium, or high, and the frequency or probability of the risk event occurring low, medium, and high. So basically, the point is if you are in a high frequency, high severity of risk category, or like here, you want to avoid whatever kind of behavior that is. So avoid it. If it's a medium probability of it happening with a high severity, again, you want to try and avoid it. If it's a low um, risk of it happening, but high severity, that's when you are able to purchase insurance to treat any kind of problem that you may have, like an illness or disease. So, going on to the next question here, what can you do about risk? Lamar is faced with a high frequency, high severity risk. According to the risk matrix, Lamar should, and if we go back to the matrix, high severity, high frequency, avoid if possible. So in this answer would be letter C, avoid the risk. So we have insurance companies, and the insurance company will, for a fee, a premium, will accept the transfer of risk to them. And so they'll take on your risk, but they'll charge you a premium. You'll have to pay a deductible and you'll have to pay a copayment. Now, a premium is a monthly fee that you pay. The deductible is going to be a fixed set amount for a year. And then the copayment is a cost sharing tool. Usually, a copayment will be some kind of a fixed amount that you pay to go to the doctor's office. So when we talk about insurance companies, they specialize in different kinds of insurance, like health, home, auto, or life, and they operate under general guidelines. So they aim to minimize their risks so they can provide protection when the frequency and the severity of a loss is relatively low. And they spread that risk out by building portfolios of assets and pooling premiums from thousands of people. When we say pooling premium, what we mean is not everybody who pays a premium is going to utilize that insurance. So if the severity and frequency of the risks increases, the premiums will also increase. Now, here's a diagram when they're talking about pooling of premiums to pay claims. Basically, these folks over here are paying premiums to the insurance company, and then somebody has a claim somewhere, and the insurance company will pay for that claim, or at least a portion of it. Basically, they're pooling this premium and they're building an amount, uh, they're saving this money in assets, and they are pooling all that money together so they can cover these costs. All right. So, what do you say? The reason you need health insurance is because risk to your health may be inconsequential, infrequent, unlikely for young people, or financially catastrophic. Well, letter D is the correct answer here, financially catastrophic. Um, health insurance, health care costs are rising faster than inflation, and the health insurance that you purchase will allow you to manage some unpredictable and potentially large costs associated with health care. If you go into the hospital now and you have a stay in the hospital, those costs will accelerate dramatically. Um, so here's what they show average healthcare costs for those in their 20s. A hospital stay here, they're showing at $10,000. Again, that depends on what the stay is for, but I've seen claims for hospital stays that are in the $40,000 range. Um, Emergency room visits, that's going to be a little bit less expensive, but still, it's going to be it's going you're going to incur quite a bit of cost there. You can, and then a doctor's office visit or prescription drug coverage. Those costs are going to be fairly low compared to the hospital stay or ER visit. So, health insurance costs, and we mentioned this a moment ago. You have the monthly premium that you start with, and then you have a deductible that's fixed for the entire year. So, if you had a $3,000 deductible, you have to pay $3,000, and then insurance will pay. The co-insurance is expressed as a percentage that you have to pay when you share costs with the insurance company. So coinsurance typically is 20% or something of that nature. So if you go to the doctor's office and they send you a bill, likely, and you have coinsurance, you'll probably be paying around 20% on that. Now, another kind of cost sharing is called a copayment, but it's a flat fee. And what that is, a lot of times that takes place when you're getting prescription drug refills and things like that. So when you go get a prescription filled, you can have a flat fee on that prescription, a copay, and the copay itself will always be there. All right, until you reach your out-of-pocket maximum. So why do insurance policies have an out-of-pocket maximum? Well, there's a limit to the amount of cost an insurance company will pay. No, not really. To share costs between the insured and the insurance company, um, that's maybe, but that's not the best answer. To avoid potential catastrophic financial outcomes for the insured. That's letter C. That is the best answer here. An out of pocket maximum means there's a maximum amount that you have to pay out of your pocket no matter what during a year that you have this insurance. So when we say out of pocket maximum, we're trying to protect an insured person from having a catastrophic financial expense that they can't afford. And so the out of pocket maximum will kick in. And then after you get the out of pocket maximum, insurance will pay all the rest of the claims. There's also a fee for service type insurance, preferred provider organization. It's basically uh, there's a network that you sign up with, and they are the approved hospitals and approved doctors that you go see. So if you sign up with a PPO, that's a fee for service plan. It offers reduced deductibles, copayment, and coinsurance if you're going to the doctor that's in the network. So this really makes a lot of difference if you go in network. A high deductible plan, and this is a very popular version, is designed to reduce the premiums as you pay more upfront medical expense out of pocket. The premiums are lower, but overall costs are higher. So they have higher annual deductibles. So here's an example: 1350 in 2018 for an individual, 2700 in 2018 for a family. Out of pocket limit cannot exceed 6650 for an individual or 13,300 for a family. So that's an example. Now the plans all differ. They're not always going to be the same, but depending on how high this deductible is, the premium will be much lower. Managed care is what they used to call HMO, Health Maintenance Organization. And basically, what this does, the health insurance company pays a per person fee every month to the managed care organization, to the health maintenance organization, and the people who are subscribers are only allowed to go to a particular place to receive service. So if you belong in an HMO, you're going to uh, be required to go to a specific location. The advantage of this is you have relatively small co-payments uh, per visit, and basically it was intended to coordinate different kinds of health care and address healthcare holistically so that they would treat all parts of the patient. So a lot of times these HMOs are aligned with a doctor's practice where they have uh, the uh, regular doctor visits. They have an ambulatory surgery center. They have other kinds of services there as well, lab, um, radiology, those things. So there is this thing called a hybrid plan, and it has some of the fee-for-service elements and some of the managed care plan. So they call it a point of service plan, which is what we were talking about with PPO. They'll have lower out-of-pocket expenses if you go to go to a provider that's in network. If you go outside the network, you have to receive a referral from your in-network doctor. All right. So what do you say? The most popular type of health insurance plan is managed care, preferred provider option, fee for service, or high deductible health plan. And they said in the earlier slides that it was the high deductible health plan, very popular um, health insurance plan. The health insurance marketplace came about with the Affordable Care Act, and in the health insurance marketplace plans, each state has a marketplace, and you can go to that marketplace and purchase insurance, even if if you don't have insurance available at work. So you have different levels of coverage. You have a platinum plan, which is low out-of-pocket maximum but high premiums. A bronze plan, which is lower monthly premiums but high out-of-pocket. And silver and gold, those are in between bronze and platinum for the premiums and out-of-pocket. Now, you can also purchase a catastrophic plan with a very high deductible but low premiums if you are younger than 30. Okay. A health savings account is something you get, and it's a tax advantage because you can set it up to pay for out-of-pocket eligible expenses like prescriptions and things like that. And when you set this up and you decide what kind of amount you want to put into it, they take that out of your check pre-tax. So you don't have any taxes that you're paying on the amounts you put in here. So contributions are limited, and you can use an HSA to pay for co-pays, prescriptions, and all that sort of thing. But you also must have a high deductible health plan if you have an HSA. Finally, there are flexible spending accounts, and these are a little bit different. It's a lot like an HSA, except you designate your yearly contributions, and then at the end of the year, if you don't use it all, you lose it. So for flexible spending accounts, it's very important that you're putting the money in there that you know you're going to use. Um, so you can pay for medical and dental expenses, deductibles, co-payments, prescriptions, eyeglasses, and things like that with a flexible spending account. Okay, so that is really it for this chapter 9 video. I will post a chapter 9 quiz with this, and we'll talk more about it on Friday. Take care and have a great day.